Here is a number that should stop you before you ever walk onto a dealer's lot. Two people buy the exact same car on the same day. Same model, same price, same dealership. One leaves paying about 5% interest, the other leaves paying over 16%, and neither one fully understands how different their situation is until the payments start rolling in. That gap is not bad luck. It is the American auto loan system doing exactly what it was built to do. This episode breaks it all down: what APR actually means, how your credit score controls your rate, how dealerships quietly pocket thousands of dollars from your loan without you realizing it, and what you can do about it before you sign anything. Let's start with APR, because most people think they understand it, and most people do. Not. When you borrow money for a car, the lender charges you interest. Your interest rate is the basic percentage on the loan. A annual percentage rate goes further. It includes your interest rate plus any lender fees, giving you the true annual cost of borrowing. That is the number that matters when you are comparing loans. Always ask if the rate you are being quoted is the APR. If the person you are talking to dodges the question or changes the subject, pay attention to that. So where are rates right now? According to Experian State of the Automotive Finance Market, the national average APR for a new car loan in Q3 2025 was 6.37%. For a used car, that average nearly doubles to 11.26%. Think about that. Used cars are cheaper, but they cost dramatically more to finance. That is not random lenders price used vehicles as higher risk loans. They depreciate faster, they carry more mechanical uncertainty, and they tend to attract borrowers who could not qualify for new car rates if you are financing a used car without shopping around first. There is a good chance you are paying more than you need to. Your credit score is the biggest lever in this whole equation, and the differences across tiers are striking. Experian's Q1 2025 data shows this clearly. A super prime borrower with a score above 780 pays around 5.25% on a new car and around 7.8% on a used car. A prime borrower in the 662-780 range pays about 6.85% on new and 9.7% on used. Drop into near prime 601-660 and your new car rate climbs to around 9.5%. Fall into subprime 501-600 and you are paying nearly 13% on new, almost 18.5% on used. Below 500, average new car rates hit nearly 16%. Here is what those numbers look like in dollars. Same $30,000 loan, same 60-month term. A super prime borrower at 5% pays about $3,162 in total interest. A subprime borrower at 12.5% pays $8,275. That is over $5,000 more in interest for the same car, the same loan amount, the same duration. Before you ever shop for a car, check your credit score. Not because it is nice to know, but because improving it even slightly before you apply can be worth real money. You can check your score free through annualcreditreport.com or your bank's app. Now let's talk about something that the finance office is very much hoping you will never hear about. When you finance through a dealership, the finance manager submits your application to a network of lenders. Those lenders come back with what is called the buy rate, the actual minimum rate they are willing to accept for your loan based on your credit profile. That rate is real, but the dealer does not have to show it to you. They are legally allowed to mark it up before presenting it to you, and they keep the difference. This is called the dealer reserve or finance reserve. The typical markup runs 1 to 2.5 percentage points above the buy rate. An MIT analysis from 2023 found that roughly 78% of dealer-arranged auto loans carry this kind of markup, with an average of 1.13 percentage points. On a $30,000 5-year loan, a 1% markup costs you around $840 in extra interest, a 2% markup costs close to $1,700. That money goes to the dealership, not to the lender, to the dealership, and you will not see it itemized anywhere on the contract. For borrowers with weaker credit, this gets worse. If a lender approved you at 14% and the dealer adds 3 points on top, you end up at 17% on a $25,000 72-month loan. That 3-point difference adds roughly $3,200 in extra interest you are already paying more because of your credit history. The dealer then charges you more because you have fewer choices and less leverage. The fix for this is simple, and it works every time. Get pre-approved before you go. Apply at 3 lenders before you visit any dealer. Your bank, a local credit union, and 1 online lender is a solid starting point. Do all 3 applications within a 14-day window. Credit bureaus typically count multiple auto loan inquiries in that window as a single hard pull on your score. Get the best offer in writing. Walk into the dealership with a real rate already in your hand. The finance office now has to beat your number to earn your business. If they cannot, you use your own financing. Credit unions are worth singling out here because most buyers skip them entirely. According to Enquidata 4Q to 2025, the average 60-month new car rate at a credit union was 5.75% versus 7.49% at banks. That 1.74 percentage point difference on a $30,000 60-month loan saves you roughly $1,500 over the life of the loan. Credit unions are non-profit. Their profits go back to members as lower rates, not to shareholders. There are more than 4,000 federally insured credit unions in the United States. Finding one and joining before you buy a car is one of the simplest, highest return moves you can make. Now to the second trap, the long loan term. The average new car loan in the U.S. is now 68.9 months, according to Experian Q for 2025. More than 22% of new car buyers are taking 84-month loans, 7 years, a record high according to Edmunds. These loans exist to make expensive cars feel affordable by spreading payments as thin as possible. Let's look at what that actually costs on a $50,000 car at 7% APR. The numbers are stark. A 48-month loan generates $6,724 in total interest. A 60-month loan, $8,463. 72 months, $10,230, 84 months, $1,050. The 7-year loan costs you over $5,000 more in interest than the 4-year loan. You are not saving money, you are spending more money at a slower pace. And that is only the interest problem. The deeper issue is what happens to the car's value while you're paying. According to Kelley Blue Book, a car can lose up to 60% of its value over time. On a 7-year loan, the car is depreciating far faster than you are paying down the balance. That puts you underwater, owing more than the car is worth, sometimes for years. If the car is totaled, if you need to sell it, or if your situation changes and you need to get out of the loan, you are stuck covering a gap. Buyers who rolled negative equity into a new purchase in Q2 2025 paid an average of $15,881 in interest on their new loan, compared to $9,619 for buyers who did not carry that baggage forward. A reasonable rule of thumb: keep your loan to 60 months or fewer. If a car requires a 72 or 84-month term to fit your budget, the honest answer is that the car is too expensive for your current situation. That is not a criticism, it is just math. This connects directly to the most dangerous question a dealer will ask you: what monthly payment are you looking for? The moment you give a number, you hand control of the entire deal to the finance office. They can engineer almost any monthly payment by adjusting the loan term, the interest rate, the car price, and the add-ons simultaneously. They will land exactly on your target number, and you will have no idea how much each of those variables move to get there. The month payment becomes the magician's misdirection while everything else changes behind the curtain. Always work from total cost and out the door price. Ask what APR they are offering. Ask what loan term. If they want to keep steering the conversation back to monthly payments, hold your ground. When you do sit down in the finance office, you will almost certainly be offered gap insurance and an extended warranty. Gap insurance is genuinely useful if you have a small down payment or a long loan term. It covers the difference between what your insurer pays if the car is totaled and what you still owe on the loan. The problem is the price. Dealers charge between $500 and $1,000 for gap coverage. Your own auto insurer will typically offer the same protection for $2,250 per year. Over 5 years, that is $100 to $250 versus potentially $1,000 at the dealer. Call your insurer before you shop for a car. If you need gap coverage, add it to your policy and decline the dealer's version completely. Extended warranty markups at dealerships commonly run between $600 and $2,000 above the dealer's wholesale cost. If you want a warranty, price it separately from a third-party provider after the sale, not in the finance office under pressure. The practical summary is this. Check your credit score before you shop. Get pre-approved from at least 3 lenders, including one credit union. Know your rate before you walk in. Keep the loan at 60 months or shorter if at all possible. Always negotiate on total price, not monthly payment. Buy gap insurance through your insurer. And when the finance manager asks what monthly payment you are comfortable with, do not answer that question. The American auto loan market is not set up to help you get a good deal. It is set up to generate revenue at every step of the transaction. That does not mean you are helpless. It just means preparation is the only thing standing between you and an unnecessarily expensive loan. Show up ready, and the deal looks completely different.